So you're looking at a stock ticker on your screen, right? And on one hand, you're seeing these falling price trends, just really negative sentiment all
Right,
around.
the chart looks terrible.
Yeah, exactly. But then on the other hand, there are these strong buy signals popping up. You've got analysts whispering that it's, massively undervalued. So you're sitting there staring at the flashing numbers and just wondering, is this a hidden gem that I need to scoop up, or is this a value trap waiting to just snap shut on my portfolio?
I mean, that is the ultimate dilemma in modern trading, isn't it?
Yeah.
The data just loves to give conflicting signals.
Oh, absolutely.
You see a flashing green indicator, but then uh, the underlying mechanics of the company might literally be screaming a warning siren and decoding which signals really, well, that's the difference between making a really smart allocation and, catching a falling knife.
Yeah, catching a falling knife is the perfect way to put it. And today, on April 17th, 2026, we are looking at a situation where that exact dilemma is taken to an absolute extreme.
It really is.
If you type the ticker symbol NG into your brokerage account today, you're going to pull up a tale of two completely different companies. I mean, polar opposites.
Right, because NG pulls up National Grid Player, which is this massive, plodding, dividend-paying utility giant.
Right.
But it also pulls up NovaGold Resources, which is a high-stakes, entirely pre-revenue gold explorer.
Which perfectly illustrates the mechanical danger of moving too fast in these markets. You really have to check what you're buying.
Definitely.
So our mission for this deep dive is to tear into the income statements, the underlying technical analysis, the insider buying behaviors, and the bull versus bear cases for both of these NG tickers. We're going to have a natural, objective debate about what the data actually says underneath the surface.
Because we want to equip you with the why and the how, not just the what's.
Exactly. And just to be super clear up front, we are not giving financial advice today. We're just pulling back the curtain on the source material so you can see the real mechanics at play. It's like typing Apple into a search bar and trying to figure out if you're buying a fruit orchard or a global tech company.
Yeah, you really need to know exactly what you're dealing with before you allocate any capital.
For sure. Oh, and before we dive into the utility giant, please take a second to hit the like button on this video and subscribe to our YouTube channel. And it is absolutely compulsory. If you want more deep dives like this, you have to leave your comments and feedback down below. Let us know what you think.
Yes, please do. We read all of them.
All right, so let's dive right into the utility giant first. National Grid is a major player. They focus heavily on electricity and gas transmission in the UK and the northeastern United States. They are basically the dictionary definition of slow, plodding infrastructure.
They are. And, their price action today really reflects a bit of a struggle. If you're looking at the New York Stock Exchange under the ticker NG, they are sitting at $86.66. So they're down nearly 1% for the day.
Right.
And over on the London Stock Exchange, under the ticker NG dot, they're at 12,274.80 GBX, which is also down about 1%.
And if we look at where they sit historically, their 52-week ranges are $67.08 to $94.64 on the NYSE. And in London, it's $1,428.50 GBX. But honestly, rather than getting bogged down in the exact decimal points, what you really need to know is this National Grid is bouncing off an invisible ceiling.
Yeah, that's exactly what the chart shows.
They are hovering in the upper middle of their yearly range, but every single time the price tries to pop its head up, it just gets swatted back down.
Right, and that is exactly what the short-term technical analysis is revealing to us right now. The market trend is currently what we call neutral bearish. So the stock is consolidating after a recent drop of almost 2%.
Okay, so a breather.
Exactly. When we see this kind of consolidation, it means the market is basically taking a collective breath. But underneath that breath, the order flow shows that sellers are actively controlling the trade. Key support is sitting at GBX 1,258.00, but resistance is right above it at GBX 1,286.02 and GBX 1,296.88.
So let's explain the mechanics of that really quickly. When we talk about sellers controlling the trade at resistance levels, we're really talking about institutional behavior. There is a literal wall of sell orders waiting at those upper price limits.
Yep, massive limit orders.
Exactly. Institutional investors have set their limit orders, so the moment the stock touches, say, 12,286 GBX in London, an automatic wave of selling just triggers. That is what causes this intraday sliding we are seeing today.
That is the hidden architecture of the market at work. And for us to see a concerned bullish reversal, like a real sustained upward trend, it needs to break above a key threshold to basically exhaust all those automated sellers.
It has to chew through the wall.
Right. And in the U.S. equivalent context, that would mean breaking with volume above $344.
Right.
Right now, though, the momentum indicators, specifically the oscillators, are just flashing neutral. Though, I should add, some weekly signals do say buy.
And oscillators, for those who don't track them daily, basically act like a speedometer for a stock's price movement. If a price shoots up way too fast, the oscillator warns you it's overbought and it might crash.
Like it's redlining.
Exactly. And if it drops too fast, it says it's oversold and might bounce. So if these speedometers are just hovering in the middle, flashing neutral, it suggests total uncertainty from the broader market. The computers just don't know which way this is going to break.
Which forces us to look under the hood at the actual financials. The whole appeal of utility companies, usually it's unshakable stability, right? And when we look at their income statement over the trailing 12 months, they were pulling in massive, undeniable numbers.
Just so we are completely on the same page, the trailing 12 months, or TTM, that is not just last year's static calendar tax return. That is a rolling snapshot. It looks at the company's performance from this exact day, going exactly 365 days backward.
It gives us the freshest data possible.
Right.
And in that rolling period, National Grid generated revenue of $17.48 billion.
Wow.
Yeah. Their net income sits at $2.87 billion. And their diluted earnings per share is a very comfortable $3.07.
Now, I want to pause on that word diluted, because retail investors overlook it way too often. We look at diluted earnings per share instead of the basic number because it represents a worst-case scenario.
It's the safer metric to use.
Yeah, basic earnings per share just divides the profit by the shares currently trading. But diluted earnings asks, what if every single employee stock option, every convertible bond, and every warrant out there was suddenly turned into active stock today?
The profit pie gets cut into a lot more slices.
Exactly. The slices get much smaller. So seeing a strong diluted number means even if the pie gets sliced up to the maximum possible amount, investors are still getting a really solid piece.
So on the surface, it looks like an immovable object of profitability. But this is where the narrative shifts pretty dramatically.
Oh, boy.
When we connect that impressive income statement to the broader balance sheet and the cash flow statement, severe structural cracks start to appear.
Yeah, this is where my eyebrows went straight up into my hairline when I read the source material. Let's look at their most recent quarter. They have about $4.06 billion in total cash.
Which sounds great.
It sounds amazing until you look at their liabilities. Their total debt-to-equity ratio is sitting at a massive 123.36%.
We do have to contextualize that debt, though. Utility companies inherently carry more debt than, say, a software company or a retail chain. They have to physically build power plants, maintain turbines, and lay thousands of miles of high-voltage cable.
Right, it's actual physical infrastructure.
Exactly. It is an intensely capital-heavy business model. But even factoring in the nature of the utility sector, 123% is a very heavy burden, especially in an environment where borrowing costs are no longer sitting near zero.
And the complexity of that debt burden really rears its head when you look at the cash flow. Their operating cash flow looks stellar, 6.8 billion British pounds annually. The business of transmitting electricity obviously generates tons of cash.
It does.
But their levered free cash flow recently hit a deficit of negative $541.88 million.
And that deficit is the smoking gun for the bears. Levered free cash flow is the actual money a company has left over in its bank account after paying all of its mandatory financial obligations.
Including the massive interest payments on that 123% debt.
Precisely. A negative $500 million means that after the mortgage is paid, they are essentially burning cash.
So I have to challenge the conventional wisdom here. National Grid pays a dividend yield of around 3.6%. Generations of people buy utilities specifically for that safe yield to fund their retirements.
Right, it's a staple in dividend portfolios.
But if the company has 123% debt and their levered free cash flow is negative $500 million, isn't this safe yield actually a classic value trap? Aren't retail traders just getting lured in by the dividend, essentially getting their own money handed back to them while the underlying foundation crumbles?
That is the exact debate tearing Wall Street analysts apart right now. The ratings are completely split because analysts are weighing that exact risk. Firms like Morningstar call the stock moderately undervalued.
Okay.
Well, they argue that a dominant utility with a monopoly on vital infrastructure in the UK and US is always going to be a cash machine long term. They think this makes it a really attractive entry point.
Got it. So they see a sleeping giant on sale.
But on the other side of the aisle, you have UBS. They recently downgraded National Grid to a sell. And their primary argument is that the stock is at a peak valuation, trading at a 57% premium to its regulated asset base.
Let's translate regulated asset base real quick, because it's the key to understanding utilities. A utility company can't just charge whatever it wants for electricity.
Right, the government regulators set their prices.
Exactly. And the regulators decide how much profit the utility is allowed to make based on the value of their physical infrastructure, their pipes, their wires, their plants. That physical value is the regulated asset base.
Which is heavily audited.
Yeah. So if UBS says the stock is trading at a 57% premium to that base, they are saying investors are paying a massive, totally unjustified markup for aging infrastructure that the government strictly caps the profits on.
That is the core of the bear thesis right there. The underlying assets just don't justify the share price. And when you look at the broader consensus among analysts, it is the absolute definition of uncertainty. Out of 11 major firms, we see 3 buys, 6 holds, and 2 sells.
And the plot thickens even more when you factor in the looming risks. We've got an earnings report coming up on May 14th, 2026. Investor sentiment is incredibly cautious right now because National Grid recently had to issue an earnings warning.
Which is never what you want to see.
No. And why did they issue it? Because of massive storm costs in the U.S., Mother Nature is literally eating into their profit margins.
This highlights the unique environmental risks inherent in utilities. You obviously cannot control the weather, but under your regulatory mandate, you are legally obligated to spend whatever it takes to fix the grid when a massive storm takes it offline.
Right. You can't just leave people without power.
Exactly. And those emergency repair costs come straight out of the bottom line.
But despite the debt, despite the negative cash flow and the unpredictable storm costs, we are seeing significant insider buying. Director Andrew Ag has been actively buying shares this month, right around $17.53 a share.
Which is very telling.
It is. Insiders generally only buy stock with their own money for one reason. They genuinely believe the price is going to go up.
And that insider buying forms the bedrock of the bull case. The bulls look at this and see a dominant, indispensable utility with a stable yield, and they see executive leadership putting their own personal wealth on the line.
That signals internal confidence that the company can restructure its debt and absorb those storm costs over the long haul.
So if National Grid is the lumbering, debt-heavy giant where retail traders might get trapped by chasing dividends,
Yeah.
well, NovaGold is the complete opposite extreme. If you flip the coin and look at the other companies sharing this exact same ticker symbol, we see a completely different kind of trap.
Okay, so if National Grid is the dividend trap, NovaGold Resources is the momentum trap. This is where retail traders can get completely demolished by chasing volatility, unusual volume, and FOMO, the fear of missing out.
Exactly. NovaGold is an exploration company. They're focused on the Donlin Gold project in Alaska. And when we look at the price action for today, April 17th, 2026, it is just explosive.
Oh, it's wild. While National Grid is barely moving, NovaGold is up almost 11% today, sitting at $11.24.
The volatility profile is staggering here.
Yeah.
Looking at their 52-week range, this stock has been as low as $2.26 and as high as $14.40 within a single year.
That is a stomach-churning roller coaster. I mean, going from $2 to $14. So what is the underlying technical analysis actually saying about this massive 11% spike today? Is it real or is it a mirage?
Well, the technicals show a stock violently breaking out of bearish pressure, driven by highly unusual trading volume. I mean, a massive influx of shares is changing hands right now. The stock smashed right through its previous historical resistance ceiling at $9.46.
So it essentially blew the roof off the algorithmic sell orders we talked about earlier.
It did. The buying pressure was so intense it completely overwhelmed the sellers. Now, it is testing a much higher atmospheric zone, right around the $11.30 to $12 mark. And by breaking that old $9.46 ceiling, market mechanics dictate that the old ceiling now becomes the new floor.
Ah, okay.
Yeah, so it has established a strong support base down at the $8 and $9.10 level.
So it's a massive confirmed trend reversal from bearish to bullish, but before anyone decides to liquidate their savings and just blindly chase this 11% green candle, the analysts are waving a massive red flag, aren't they?
They really are. Analysts at Central Charts are advising extreme caution, labeling this short-term surge as truly tentative.
Truly tentative. I love that. That is peak Wall Street speak for, yes, the line is going up, but the foundation is completely made of sand.
Exactly.
And when you examine their financials for the first quarter of 2026, it becomes painfully obvious why the institutional analysts don't trust the momentum here. National Grid had $17 billion in revenue. NovaGold, they are pre-revenue. They have exactly $0 coming in from sales.
Because they are an exploration company, they do not have an active operational mine pulling gold out of the ground to sell to the market. They are just trying to secure the legal right to eventually build that mine.
Which means their entire corporate existence right now consists of burning money.
Pretty much.
Their Q1 shows a net loss of $15.4 million, which is actually an increase from the previous year. Their general and administrative expenses shot up by $3.9 million. And why did they shoot up? Mostly due to professional fees.
Right, which means lawyers.
Lawyers, lobbyists, and environmental consultants trying to push activity at the Donlin Gold site forward.
However, they are not exactly operating on fumes just yet. Their most recent quarter shows a total cash pile of $394.18 million. And unlike the crushing debt load we saw with the utility, NovaGold's debt-to-equity ratio sits at a highly manageable 38.41%.
Okay, I have to push back on this narrative of financial safety, though. $394 million sounds like a dragon's hoard to an everyday retail trader.
Sure, it's a huge number in isolation.
But let's be entirely realistic about the mechanics of what they're actually trying to do. We are talking about building a commercial-scale gold mine in the rugged wilderness of Alaska.
Oh, the logistics are a nightmare.
Right. There is no existing infrastructure. You have to build roads, water treatment facilities, and power plants just to run the heavy machinery. Is nearly $400 million actually enough to achieve that, or is that just the down payment on the lawyers?
That is the critical context right there. That $394 million is a war test meant to survive the permitting phase. It is not necessarily to fund the entire construction of the mine. It is a race against the clock.
Because they're burning $15 million a quarter.
Exactly. They are hoping to finalize the legal right to mine before that cash pile dwindles to a point where they have to take on toxic debt or, even worse, dilute their current shareholders by issuing more stock.
Jumping into a pre-revenue miner like this, it honestly feels like funding a massive Hollywood blockbuster before they've even finished writing the script.
That's a great way to look at it.
I mean, the box office potential is astronomical. You look at the Donlin Gold asset, and it's like having the rights to the next billion-dollar franchise. But right now, as an investor, you aren't paying for special effects or ticket sales. You're paying millions for caterers, location scouts, and lawyers. And you're just praying the government regulators greenlight the project so you can actually start filming. If the permits fail, you don't have a movie. You just own a very expensive pile of unfilmed scripts. You are pricing in a flawless premiere while carrying 100% of the pre-production execution risk.
That analogy perfectly captures the binary nature of this investment. If a single critical environmental permit gets permanently denied, the intrinsic value of the company effectively drops to zero.
Just vanishes.
Yes, regardless of how much gold is actually in the ground. And analysts recognize this binary risk. Still, the consensus rating is a moderate buy, leaning heavily optimistic with 7 buys and 1 hold. Morgan Stanley actually just initiated coverage on April 9, 2026, with an overweight rating and a target price of $13.80.
Which implies a massive upside from its recent lows. We're talking like plus 37% from the bottom. But Morgan Stanley's rating comes with a massive underlying caveat, right? Their valuation only holds if the permitting for the Donlin Gold project continues successfully.
That is the big if.
Without the permits, the gold stays buried, and the war chest burns to zero.
Yet the people closest to the project seem entirely unbothered by that risk. Unlike the cautious, really mixed signals over at National Grid, NovaGold insiders are heavily, aggressively bullish right now. The data shows net insider buying of nearly $440,000 in just the last 90 days.
Wow. Specifically, directors Don Whitaker and Daniel Muniz Quintanilla made massive personal purchases in February 2026. And it is not just the executives. Institutional ownership is remarkably high at 57%.
That's huge for a pre-revenue explorer.
It really is. Smart money, we're talking hedge funds and massive asset managers, is actively parking capital in this stock.
Which sets up a fascinating contrast for the bull and bear cases. The bears see a hype machine driven by retail FOMO. They see a stock that popped 11% today, luring in amateur traders who will basically get trapped holding the bag when the momentum inevitably fades.
Because the company is just going to spend the next 2 years silently filling out regulatory paperwork.
Exactly. But the bull case is built on the sheer, undeniable magnitude of the Donlin Gold asset, combined with that overwhelming insider confidence. The insiders and the smart money are looking at the geological surveys and the political winds, and they are betting heavily that those permits will clear.
So we have explored two wildly different companies operating in an entirely different reality, brought together by just a quirk of the ticker symbol NG. If we synthesize the outlooks here, how should an investor process these two totally distinct risk profiles?
I think it depends entirely on your time horizon. If you are looking at the short-term perspective, National Grid offers nothing but uncertainty.
Right.
The stock is trapped in consolidation between automated buyers and sellers, and it's nervously waiting for the May 14th earnings report to reveal just how badly the U.S. storm costs damaged the bottom line.
And NovaGold.
Well, NovaGold in the short term offers explosive 11% momentum. But as Central Charts warned, it is highly tentative and very vulnerable to a violent pullback if the trading volume dries up.
And if we zoom out to the long-term perspective, the debate shifts from daily price action to fundamental survival. With National Grid, the long-term question is whether a massive utility can actually manage its 123% debt load and these unpredictable climate-related expenses without eventually being forced to slash the very dividend that attracts its investors in the first place.
And with NovaGold, the long-term perspective is just a brutal race against the burn rate. Can they secure the final legal permits and start moving dirt at Donlin before their $394 million war chest completely evaporates?
It really comes down to understanding the mechanics of what you are actually buying. A ticker symbol is just a door. You have to understand the machinery operating behind it.
Exactly. We started today by asking if the data we were looking at was a hidden gem or a trap. What we uncovered is that there are two completely different ways a stock can be a value trap.
Yep. Are you buying a lumbering utility choking on the debt required to maintain its aging infrastructure? Or are you buying a pre-revenue explorer burning millions of dollars in cash on the dream of a permit?
The data provides the map. It outlines the technical resistance, the levered cash flow deficits, and the insider confidence. But ultimately, you have to decide which terrain your portfolio is built to navigate. Is it execution risk or balance sheet risk?
So we want to leave you with a final provocative thought to mull over as you look at your own investments. Looking at these two extremes, the giant utility managing a crumbling grid and the hopeful explorer fighting for the right to dig what is actually the bigger systemic risk.
That's the real question.
Will NovaGold's Donlin project successfully navigate the labyrinth of environmental red tape before the cash burns out? Or will National Grid's mounting storm costs and heavy debt burden eventually swallow its dividend entirely, permanently trapping the conservative investors who thought they were playing it safe?
A question that the mechanics of the market will eventually answer for us.
Thank you so much for joining us on this deep dive into the underlying data. We appreciate you exploring the mechanics with us. Before you close out, please remember to hit the like button on this video and subscribe to our YouTube channel. And it is absolutely compulsory if you want more deep dives like this. Leave your comments and feedback down below. Let us know which of these two traps you think is the bigger risk. Until next time, keep looking past the surface numbers, and we'll see you on the next deep dive.